Okay, hi there. Welcome to our first real estate rundown. This is a monthly webinar we're going to be doing on the second Thursday of every month, just to share whatever's going on most recently in the real estate and mortgage market. So things are always changing. There's always lots of information, and the strategies that are working also can change really quickly. And so my goal with this is to share the most updated market stats and the most updated things that are working for our clients and our real estate partners. And so I hope this will be informative and useful for you. So first off, my name is Daniel Jackson. 2024 is my 21st year in the mortgage business. And my goal for this year is to be more of a financial educator and to share a lot of the information, because I'm always spending a ton of time on staying on top of the market trends, staying on top of mortgage guidelines and changes in the real estate and mortgage markets. And so what I want to do is make sure that I'm sharing that information and not just keeping it bottled up. So this webinar series is part of making that goal happen. Now for today, we're going to talk about the most updated market stats, as well as a forecast for what's likely to happen with rates and home prices in 2024. And we'll talk about a few common questions that we're getting recently, which is about escrow accounts and home equity lines of credit. And then a few strategies that I've seen winning most recently, which is dealing with lowball offers, fulfilling the affordability gaps, and doing fully underwritten pre-approvals in order to help buyers compete with cash offers. So let's just jump right in. First, we'll talk about mortgage rates. So you can see this chart is the last year of mortgage rates. The blue line is the 30-year fixed, and the green line is the 15-year fixed. Now look at when it capped out at just under 8% in October of last year. Rates have come down over a 1% since then, and we're back down to 6.62 on the 30-year fixed. The other thing that's super interesting is this gap between the 15 and the 30. A lot of times people will think, oh, is it a 0.5%, or do I save 0.75% by going with the 15-year? And the answer is that's always changing. Sometimes that is more and sometimes it's less. And lately it's been less. There's just been less need for 15-year fixed loans, less desire for them even on the secondary market. And so they just are not that much of a savings to consumers. That's always changing. Now, it's interesting if you zoom out on this chart a little bit, like here it is back to 1970 or 71 or so, the long-term average of 30-year fixed rates is about where it is right now, 7.25, 7.5, something like that. But when we hit that 7.79, that was the highest it had been since November of 2000. So that's a 23-year high in mortgage rates. And if you look at just more recently, after COVID, rates were under 3% for a short period of time. And so if we're going from 2.65 to almost 8%, rates are almost tripling. And so buyers who didn't make the move back when they wish they should have are really feeling the pain now of these mortgage rates. And that's why, even though this is historically the rates right now are not that bad, they're a lot worse than they have been for the last decade or so. So what's likely to happen with rates? Something that I watch on at least a monthly basis is the Fed Futures Index, which basically is just the stock market betting on what the Fed is likely to do with interest rates. Now, when they cut the Fed funds rate, it's not directly tied to mortgage rates, but they're cutting rates because they see inflation is under control, things are slowing down, and they don't need to continue to hike with the hiked rates in order to slow things down any further. So when it's news like that, that tends to help mortgage rates. Now, these are odds, just like if you're betting on a football game or something, and the odds of a Fed cut starting in March, there's a March 20th meeting, and we're at 68% chance of a cut. Now, when they cut, it's usually 0.25%. But you can see over to the right, it says there's a 56% chance of them cutting 0.5%, so a double cut. And then in May, 94%, as well as a 91% chance of another half cut, and a 53% chance of a 0.75 of a point cut. And then you can see for the rest of the year, the market has priced in 100% chance of them continuing to lower rates. Now, these things change fast sometimes, but for right now, that's kind of what we're looking at, is we're likely to see rates going down this year. The forecast for the 30-year fixed mortgage is between 5.5% and 6%. Now, the Fed is also likely to put us into a recession. And if they do, more than likely what's going to happen with rates is they'll act similarly to the way they have at recessions in the past. So here's every recession back to the 70s. And you can see that when the economy goes into recession, the mortgage rates decline, they go down. So what's likely to happen this time? Probably similar to what has happened in the past. So that's another sign for lower rates. Now, a lot of buyers I've had this conversation a lot of times lately of, okay, let's wait till rates come down and then we'll buy a house. So this chart I find super fascinating, which is showing you mortgage rates side by side with home appreciation rates. So did home prices go up or down on the years that the mortgage rates were high or low? And really, I haven't found any correlation. Like just scouring through this, I don't see a correlation between mortgage rates going down and home prices going up or down or anything. So say, for example, it's 1976, rates are at 9%, and you say, okay, I'm going to wait until rates come down a little bit more. They need to be below 9% before I buy. Well, just look at it. That didn't happen until 1992. I mean, you would have missed out on all these years of sometimes double digit, just high appreciation rates, and you'd end up paying a much higher interest or much higher price for your house by waiting. And so there's really no historical context for waiting for rates to come down before you buy a house, because those two things just don't seem to impact each other. Common sense says they would. Now, during recession, housing tends to stay pretty strong. You can here's the recessions again, these bars, and you can see every single time except for the housing crash of 2008 that home prices continued to go up during the recessions. So housing stays strong during recessions. Now, part of the reason why we're seeing housing demand up and home prices up so much is because of this chart, which is demographics. This shows you the number of babies that were born each year in the US. And so you can see, based on the fact that the average home buyer is 33 years old, the number of 33-year-olds today, well, somebody turning 33 this year was born in what, 1990 or 1991. So just the number of buyers, the number of people born in 1991 was drastically higher than it has been for the last couple of decades. And so there's just this increasing number of people that are homebuyer age that are alive in the US. And you can see it starts to kind of wane off. So who knows what the future holds. But for right now, you have all these years of increasing numbers of home buyers and not that many homes being built. So this chart shows you side by side. The blue line are the household formations. And you can see, so I didn't put 2023 on the chart here, but in 2023, there was about 2 million households created, and there was only about 1.5 million homes built by home builders. And so that's one of the reasons why prices have to stay firm and inventory is going to remain thin, is we're just not keeping up with the increase in the population. So a big factor for a lot of people is affordability. And if you listen to the news at all on real estate, especially CNBC, they talk about affordability just being terrible. So I want to just give you an example here that, okay, and just to keep the math simple, I'm just using principal and interest payments. So say you took out a loan for $240,000 in 2021 and your interest rate was 2.875, your monthly payment would be around $1,000 a month. Now the same house might cost you $280 now, and the interest rate at 6.625, the payment's $1,800. So that's an 80% increase in your house payment, which is pretty bad. That $800 increase is just crazy. And you might think, okay, so do I need an 80% increase in my income over the same period in order to qualify for the house? But no, that's not how the math works. So in order to be equal, you need to make up that $800 difference. That's only a 20% increase in your monthly income. And according to ADP, incomes have risen 15% since 2021. So yeah, it's less affordable for sure, but it's not as bad as they're making it out to be. Now, of course, everybody's case is different. Not everybody's income went up exactly 15%. But on average, that's how it looks. These low inventory is likely to keep pushing home prices higher. So there's not much relief in sight for home prices going down. Now, we have 63 years of data on our local Yuma market, and it's the average appreciation rate over that 63 years is 4.45%. Now, the forecast for this year is a little higher. I think it's closer to 6.5, but just for conservative numbers, I'm going to use that historical number and say, okay, let's say you bought a house today for 300,000. If the 4.45 holds true, then 3 years from now, the house is going to be worth 338. 5 years from now, it'll be worth 366. And the other thing to take into account is your amortization. So yeah, by the end of 3 years, your house will have gone up 39,000. You will have also paid it down 8,600. So you're really what you're missing out on by not buying and waiting for rates to go down or whatever is 48,306. So we know that all the loans that we have done over the last year, maybe 2 years, and maybe even for the next year, are going to end up needing to be redone at some point because they're going to have a higher than market rate once the rates come down. And so our team offers a rate redo program. So the way it works is we don't charge any lender fees to redo your loan. We usually are able to put it together with zero out-of-pocket cost. And in a lot of cases, we are, even if you want, are able to keep you with the same term. So if you take out a 30-year loan and then it takes 2 years before you're ready to refi, you have 28 years left on your loan, and we can redo your refinance at a 28-year term if you want to do that instead of a 30. So it's become more and more important that we do this, that we keep track of our clients and make sure that you're in the best possible loan for you. And so we've invested in some software and some different processes to make sure that we're keeping on top of that for our clients. Now, real estate is very local. So last year, the average appreciation rate in the US was about 5.5%, but you can see it varies pretty widely state by state. I mean, here in Arizona, it's only 1.91%. So homes went up less than 2% last year. California, 2.45%. Washington and Oregon, 1.5% and 0.5%. And some of the states over in the East were 8 and 9. Even you look at Maine is 11%. So there's, it changes market by market. Now here in Yuma, Arizona, this is what it looked like. This goes back to 2006, but you can see if you just compare 2022 and 2023. Now in our market, we have a lot of manufactured homes and there's some condos and other property types. So when you look at the market as a whole, that's this black line with the red dots. In 2022, the average sales price was 270,000, and the average price in 23 was 271. So that's only about a 0.5% increase, very flat. And then the blue line is just single family homes, which went up from 306 to 311. So that's just under 2%. So that was pretty much in line with the Arizona average. Some other interesting market stats. I don't want to spend a ton of time on this, but I thought this was super fascinating. Is some other things that are happening in the market is, so look at this on the top left where it says percentage of sales with price reductions. So that means the seller put the house on the market at a certain price, and then they had to reduce the price before they were able to get it sold. Now in the end of 2022 to the beginning of 23, we saw quite a skyrocketing of this. You had 45% of homes had to be reduced before they got sold. And last year, it's a little closer to 20. It's between 20 and 25% month by month. So compare that with over here on the bottom right where it says list to sold ratio. This just shows you what percentage of the asking price, and it means the final asking price after it was reduced, did it end up selling for. And you can see at that same time period, some of the homes had to be reduced, but they were selling for over 100% of asking price in a lot of cases. And that's dropped a little bit. Now we're at like 98%. So homes, once they're priced right, they tend to sell for pretty close to their asking price. That 98% means that whatever they're asking, you get it sold for 98% of that asking price. Now, unit sold is kind of no surprise because there's fewer homes for sale and there's fewer buyers that are interested in buying. And so you have fewer homes. The overall trend is just down. We're just not selling as many homes. But the average days on market, I thought was interesting that this overall is trending down, means that a day on market means from the day you list your house to the day it's completely done and closed and it's out of your name. That's how many days it takes for you to get rid of your house. And that overall is down. So the good ones tend to be going pretty quickly. Now, bottom left, percentage of sales with concessions. This is showing you a concession is when the seller pays fees on behalf of the buyer. Now, after COVID, through 2021 and a lot of 2022, we saw almost no sales. This shows that it was around 20%, but I mean, it seemed like forever we didn't see any sales with any seller concessions, and now it's up closer to 50%. So 1 in 2 sales is happening with concessions from the seller, meaning which the concessions are very useful, and I'll go over a couple examples in a minute. But concessions are ways of allowing the seller to help cover some closing costs and maybe buy down points to help the buyer get a lower interest rate, things like that on behalf of the buyer, which helps to get houses sold by making it available to more potential buyers. And then the last one, average sales price. I love this chart because I like to look at this every single month and just see kind of how it's working. And you can see it peaked, home prices peaked, and then they came down a little bit, and then they came back up and down. And so overall, you've seen some months where we have had decreases in the average sales price, but overall, it's just very flat. Overall, it's very flat. So let's change gears and talk about what's working right now. So first off is escrow increases. So every month when you make your mortgage payment, your mortgage company is collecting and setting aside in a separate account the money to pay your taxes and insurance. Now, your property taxes are due twice a year, and your homeowner's insurance is due 1 time a year. So when they collect that money, when they go to pay your insurance, if your insurance company has increased your premiums, then they're not going to have enough funds to pay the full bill. And they're going to come back to you and say, okay, you have the option to either we'll increase your payment and we'll just divide it out over the next year to make up the difference, or you could pay a flat fee and then keep your payment the same. Same thing with property taxes. As home values have gone up, property taxes are raised at the same time. And so with the taxes going up, sometimes your mortgage payment has to be adjusted upward to make a difference with that. So homeowners insurance is interesting. And I know this is drastically different in different markets. California and Florida, where there's been a lot of natural disasters over the last few years, have really seen their insurance costs skyrocketing, but that impacts other areas of the country as well. And even if you're in an area that doesn't have a lot of natural disasters, you might have still seen your homeowner's insurance go up quite a bit. So it might be an opportune time to get a second opinion on your homeowner's insurance. So how that looks is different insurance companies have, and I've talked to a lot of agents that will tell you that different companies have different property types that they like and things that they don't like. So some companies will charge more for older houses, and some companies like the older houses. Your distance from a fire hydrant can impact you more with some companies than others. And so it really can pay to shop around on your insurance and maybe talk to an insurance broker who can look at 7 or 8 different options and just find the one that fits you best with good coverage and the lowest possible premium. So if you want a referral to an insurance agent, please reach out. We'd love to set you up with somebody who can take a look at that for you. The other thing is really important to check your property tax bill. It looks something like this. This is my property tax bill, and you can see it's broken down line by line with all these different items. Now, we had some people that bought new construction homes, and as they're looking at the line items, they saw that they were actually being charged a commercial rate for their residential property, which is higher. And so they had to go back to the county and dispute that, get it fixed, get a refund, and then lower their mortgage payment by that amount. So, I mean, I look through this, I don't even know what most of this stuff is. So I don't know, but sometimes you'll see a glaring error that's worth reaching out to the county assessor and getting it fixed, because you can save some money that way. Okay, another thing that's happening is the top chart here shows you the personal savings rate. So this is in the United States, how much money are people putting aside? And it's almost at zero. People are just not saving much money right now. And the bottom chart is credit card balances, which this only goes through the beginning of last year, but credit card balances went up over $1 trillion on a national basis, and interest rates were at 20%. Well, as of this week, the average interest rate on a credit card is 27.84%. So if you're carrying any kind of credit card debt, it's costing you a lot of money. And that's made it to where it's really attractive for people. And we've had a lot of our clients reaching out and asking about HELOCs, home equity lines of credit. So let's talk about this really quickly. Is a HELOC is a second loan that allows you to access up to 90% of your home's equity. So say your house is worth $100,000, that means you could get a loan up to $90,000 minus whatever you owe on your first mortgage. Loan amounts between $25,000 and $250,000 are allowed. The way it works is just like a credit card for the first 10 years. They call it the draw period, where you only pay interest on what you use. And if you pay it down, then you can access it again and draw it back out for other purposes. So after the 10 years, then you have a 20-year repayment period where you can't draw from it anymore and you just pay it back. So it's a 30-year loan. Now, these loans are always variable rate, and they're usually based on the Wall Street Journal prime rate, which right now is at 8.5%. So the lowest rate you're going to see on these is 8.5%, and it's usually prime plus, depending on how much you're taking out, your credit score, your property type, and a few other factors. So we've seen these between the 8.5% and sometimes 12 or 13% in some cases. So you just have to look at it and see, but it's an option that allows you to access your home equity without messing with your first mortgage. So especially people who have a super low rate, below 4% on their current mortgage, you just don't want to mess with that if you don't have to. But something that we've done with people is a calculation called the blended interest rate. And this is an actual example right here of somebody, one of our clients that had a 2.49% interest rate on their first mortgage. But when you add up all the other debt and you combine them, they have a blended rate, the total that they're paying of 8.25%. And so that 2.49 was actually not helping them. So in this case, we looked at the HELOC and it didn't make as much sense as doing a cash out refinance. So we actually paid off, and you're going to hate me for this, but we paid off the 2.5% loan, which was also a 20-year fix. She was 2 years into it. So she had 18 years left on her mortgage at 2.5%. But we paid that off and did a new 30-year fixed at 5.75. But before you get angry, let me just show you the end result. So over here where it says existing, this is the mortgage, the taxes, insurance, and then all of her other debts were $1,704. So she was paying a total of $2,553 a month. After we redid the mortgage, her payment went to $1,225 total. So the monthly savings was $1,329. The cool thing in this case, though, was she didn't really need the monthly savings. She was doing fine with the $2,553. She just didn't like paying all those 18 and 20% and all these crazy interest rates on the credit cards. And so what we did is put her on a plan where she put that extra $1,329 towards her mortgage. So even though the mortgage statement says $1,225 is your payment, she paid $2,553, keeping her out of pocket exactly the same. And this puts her on track to have her whole loan, her whole mortgage paid off in 7 years and 11 months. So we went from 18 years left on the loan to less than 8 years left on the loan, shaved 10 years off the term. She'll be completely debt-free, including the mortgage. And even though we increased the interest rate on her mortgage, we decreased the amount of interest that she's paying drastically over that amount of time. So I thought it was pretty cool. The point of the story is just be open to options. And sometimes a 2.5% rate might actually be costing you more than you know. So we could look at the HELOC, we could look at all the options and just see what's best for everybody's individual situation. Now, changing gears again, let's talk about home sellers and home buyers. So what happens in this market right now is somebody will go out and look at a house on Zillow and it'll say, hey, this house has been listed for 35 days. There must be something wrong with it. They're asking $350. I'm just going to come in and offer less. So now this is a fictitious example. I just made these numbers up, but let's say in the first column here, it says list price $350,000. So you're selling your house for $350 and a buyer comes in 10% less and says, okay, I'm going to give you $315. Well, just realize that at some point, you're going to be both a buyer and a seller. If you're selling your house, maybe you're buying another one to either downsize or move up. And so you're going to have to deal with it from both sides. So I think it's good to have the perspective of being open to looking at, okay, how does this impact me as the seller? And how does this impact me as a buyer? So on the seller side, if you were to take that offer of $315, now you're going to end up netting, look down here at the bottom, $35,000 less than with the full price offer. And what about the buyer? Well, the buyer's monthly payment goes from $2,195 to $1,975, so they save $220 a month. Here's a way of structuring the deal so that you both come out pretty much the same or a little bit better. Buy down counter. So what I'm showing you here is as a seller, you counter back to the buyer and you say, okay, I'm not selling you a house for $315. We'll keep it at $350, but you offer to buy down their interest rate. So notice over here, you're paying 7%. And again, this is a fictitious example, but we're just, I looked at the difference in cost for an interest rate at 7% versus 5.875. And it's a little under 3 points, which is about $9,000 cost to the seller. So you as the seller offer to pay $9,000 of the buyer's cost to get them a 5.875 rate. The net to the buyers, their monthly payment's almost exactly the same as it would have been if they'd paid $315 for the house. And the net to you as the seller is it's only costing you $9,000 instead of $35,000 to give the buyer the same exact difference. Now, one thing I kind of glazed over was the cash to close. So if you look at this, you'll notice that because they're putting less money, you pay less for the house, you're 20% down on 315 is less than it would be at 350. So you could notice the cash to close here is about $7,000 difference. Well, you as the seller can also offer to pay that if you want to, or if you have to keep their cash to close the same at 67, you just pay another 7,000 on top of the 9, and it still is only costing you 16 instead of 35. So there's a strategy for you. Now, this is the same exact example, but it's a little bit different in that sometimes people can't qualify for quite as much as they want, especially with prices and rates being as high as they are. Maybe the buyer's max qualification is only 315, so they can't qualify to buy a house for 350. So how we can use the same strategy of a permanent interest rate buy down to stretch their qualification from 315 up to 350 and help them get the house that they want. So as a seller, you just might keep this in mind that in some cases, the buyer might not qualify without those concessions. Like this buyer could not buy the house for 350 without that permanent buy down because they wouldn't qualify for it. So anyway, there are strategies available by working with a good lender, by working with a good realtor on both sides of the transaction. There's ways of making deals work for both sides. So I hope that's helpful. Another thing is that in 2022, I don't have the numbers for last year, but I know it's about the same. It's about 1 in 3 homes were sold to cash buyers. So if you're a seller and somebody says, okay, I'm going to buy your house and I'm paying cash, I'm not getting a loan, you like that because there's things that can go wrong during the loan approval process, and maybe that it appraises low and stuff like that. So you don't have to deal with that if you have a cash buyer. So if you're not a cash buyer, how do you compete with the other 1 out of 3 buyers in the market that is paying cash? Well, the way we do it is through a fully underwritten pre-approval. So the way this works is we complete pre-underwriting on your file, which means we get you fully pre-approved with everything except for the appraisal and title. So we're approving your file with your income, your assets, your credit, all of that stuff is already completely signed off on by the underwriter. All the questions are answered, all the documentation is provided. And then in some cases, then you're able to waive your appraisal contingencies and your financing contingencies and act as if you were a cash buyer, and we're able to close on those super quickly. So the requirements for making that work, though, is you don't want to jump through all these hoops and then have your documents expire. So we only do this for people who are actively making offers on properties within the next 60 days. And then you have to be willing as a buyer to provide all the documentation that's asking for. So the reason why I point this out is because in this market, what's happening is mortgage companies are hungry and they want to make it look as easy as possible to do business with them. So you might come to my team and we say, okay, in order to get your loan pre-approved, we're going to need your taxes and your pay stubs, and we need you to talk to your insurance company and talk to your employer and get a verification done, and on and on and on, and lots of documents. You might go over to brand X and they'll say, hey, we've already pulled your credit and you're pre-approved with no documentation. Well, the thing you have to realize is that's not a fully underwritten pre-approval. And that's actually the reason why sellers have an issue with finance buyers versus cash buyers, is because things can go wrong. So from a marketing standpoint, the other company is trying to make it seem easy to do business with them, whereas we're going to make you jump through a lot of hoops. So you just have to understand that it's a different process. We're not trying to sell you on using us. We want you to commit that you feel comfortable that we're the right team for you and that you're going to use us and you're done shopping for your mortgage, because we're going to go to work and put a lot of time and effort. A lot of people on our team are going to be putting time and effort into your file, and we're going to be out there going to battle for you to help you have the highest chance of getting your offers approved. So I hope that makes sense. Well, that's all I have for today. This is my contact information here. You can scan the code, and please reach out if I can do anything for you at all. I really appreciate you joining us for the webinar today, and we hope to see you again in the future. So thanks a lot.